And let's start out the show today with a little money chat. Any first-time homebuyers listening to the show today, I want to talk about a tax credit available. Mortgage Credit Certificate, or the MCC, specifically is for first-time homebuyers. The definition through the Washington State Housing Finance Commission, which offers this tax credit, first-time homebuyer means that you have not owned or occupied a property in the last 3 years. So if you currently own a property, maybe it's another state, and you actually relocated here to Seattle and you haven't bought yet and you've been renting for 3 years, you are considered a first-time home buyer, even though you currently have another home. Again, you haven't owner occupied a property in the last 3 years, you're considered a first-time home buyer. Or maybe you were affected by the mortgage meltdown and financial crisis that we had, and you haven't got back into the home ownership yet. If it's been 3 years, you're considered a first-time home buyer. This is a tax credit, not a deduction. The difference between a tax credit and a deduction is a percentage of a certain dollar amount. A tax credit is a dollar for dollar. So dollar for dollar, 20% of all of the interest you pay on your mortgage is a tax credit. So you get it back. It's really simple math. On a $300,000 loan amount at a 4% interest rate, not quoting interest rates today, hypothetical example only. Obviously, it depends on what the market's doing and based on qualifying factors. But if you had a $300,000 loan amount at a 4% interest rate, 20% of your interest would be $12,000. 20% of that would be $2,400. So if you divide that by 12 months, that's a $200 a month tax credit. So that's pretty substantial. If you want to know what $200 is going to do for you in buying power, because really that's where the key to saving on a payment really is how is that going to increase your buying power? It's going to increase your buying power, give or take $30,000 to $40,000, depending on what interest rates are doing, what property taxes and insurance would be on the home. But if I could tell you a way that you could purchase another $30,000 to $40,000 in a home and keep your payment exactly the same, that would be a real benefit to you. Now, this is a government-backed program, which means that you're actually going to receive a certificate that you include in your tax returns every year that says that you qualify for this special 20% tax credit. Now, if you don't amend your W-4 with your employer, you're going to see that benefit at the end of the year. So if you had $2,400 in interest that you're getting a dollar for dollar credit back, it means that you're going to pay $2,400 less in income taxes. But the idea is to be able to see this money in your paycheck every single month. We're talking about an additional $200 a month in this example that I'm giving you. So consult with a licensed CPA. I'm not, so I can't tell you how to amend your W-4. But if maybe you're claiming 0 now and you need to be claiming 2. Maybe you're claiming 2 and you need to claim 3. Whatever that number is, so that you could net and take home in your paycheck an extra $200 a month in your payment. That way you're not waiting to the end of the year to receive that back. Now you're going to receive your standard deduction on the rest of the interest, so that other 80% interest that you pay, the deduction that you would get for being a homeowner, you're going to be able to get that. So you'll get your dollar for dollar on the 20%, and then you'll get the percentage of the other 80% for your deduction. Again, I would amend your W-4 to account for all of this, because I don't know about you, but me personally, I don't want the government collecting interest on my money. I want to maximize what I'm taking home on a monthly basis so that I can utilize that myself. Higher buying power, maybe invested in something that's going to give you some type of return. Lots you can do with that money. Now, this is not a loan program. It is a tax credit, which means it goes in conjunction with any loan program you want. So conventional financing, FHA financing. If you're a veteran, great financing for VA. You can, veterans out there in VA financing, you can use the tax credit with that. USDA, if you're purchasing in a rural area, you can use the tax credit with that. Adjustable rate mortgage, fixed rate mortgage, any mortgage that's available out there, you can use the tax credit. Also, you've heard me talk about grants for first-time home buyers. There actually is a grant available now where you don't have to be a first-time home buyer, money you don't have to pay back. Another topic for another money chat, but you can use the tax credit in conjunction with a zero down or a grant program as well. The fee associated for this, there's a $650 one-time upfront fee that's part of your closing costs, because there is a lot of processing and things that the Housing Commission does have to do. Housing Commission, a nonprofit organization, so they're not there to make money, but they do need to pay for the staff to process this, and it's a government-backed program, so guarantee there's a lot of paperwork that they're doing to accommodate to this. Now, if you have not heard of this program, you may be even in the industry as a real estate professional and have not heard about this this program. A lot of people don't know about it, and here's why. Because number one, a mortgage consultant needs to be certified in order to offer the program. A lot of consultants can't get certified. If you're a broker, you don't have access to it at all. Maybe the company they work with do not support the MCC, mortgage credit certificate tax credit. So a mortgage consultant in that situation is not going to be talking about something that they can't offer. Here's the other reason. It's a lot of work for your mortgage consultant or mortgage professional. So it's kind of like doing two loans and getting paid for one. So there's a reason maybe you don't hear about the tax credit, but I'm telling you here today, it's available. It's a huge savings, and there's no reason you don't want to utilize it unless you can't qualify for it. Now, if you decide to refinance your property, you can actually reissue the mortgage credit certificate, that tax credit again with your new loan. No, if you're out there owning a home right now and you want to refinance, if you didn't originally take out the tax credit, you can't refinance and get it. You have to have taken it out at the time you purchased your home as a first-time home buyer. But if you utilize the tax credit now and you think we might see lower interest rates, I doubt that's going to happen. But if you were wondering and thinking it might, you can reissue the tax credit again with any refinance you do. You're just going to pay a one-time fee again with the new loan, $450 versus the $650 you paid for the first time. There are income restrictions to qualify for the program depending on the county that you're purchasing in. If you're purchasing in King or Snohomish County, a 1 to 2 person household, $90,000. So there's where you're not going to if you're not a first-time home buyer, or if you make more than the maximum income restriction is where the issue is going to come in qualifying. 3 or more. So if you have a child, a baby counts as your third family member. That would be $97,000 instead of $90,000. Pierce, Thurston, and Kitsap County, 1 to 2, $80,000. 3 or more in your household, $90,000. Purchase price limitations are going to vary in county as well. If you're purchasing in King, $450,000 maximum purchase price, and if you're purchasing in Snohomish, Pierce County, maximum purchase price $370,000. It's eligible with any property type. If you're purchasing a single family, condo, townhouse, manufactured properties, it is available with those as well. And here's another benefit. It actually helps you qualify for more. If for some reason you're having any challenges with your debt to income ratio, which determines the maximum that you can approve for in a mortgage payment, that $200 a month I told you it would save for qualifying for the tax credit, that's going to get added over to your income. So then you're going to be able to qualify for a higher purchase price. Most likely it's going to give you qualification, maybe another $10,000. The reason it's not the same as your buying power is because you're just getting a percentage of that in the qualifying factor. Usually it's going to be a 45% of your debt to income ratio that you can utilize to qualify. So great program for those of you that are fall within the income restriction and first-time home buyers. Give the show a call, 1-855 400-1150. Again, it's 1-855-400-1150. Ask to talk to your host personally. I'm a mortgage expert. That's what I do for my full-time job, and I'd love to assist you in that arena if you need any help. And coming up next in the Money Hour, Tyler Freed with Windermere Real Estate Lake Taps, talking on real estate right here at 1150 a.m. KKNW after this short break.